Mr. Rama Mohan Rao Amara also joining us now, MD and CEO at SBI Card. Lots to discuss, particularly on the earnings front. Sir, to start off with, profit growth has been strong, yes, but operating profits before credit costs have actually come down. So tell us what led to the strong profitability this time around despite higher provisions.
Our focus on sustained growth that was always there, it continued. We carefully calibrated, particularly when we saw a kind of spurt in the delinquencies, we calibrated our new acquisition in such a way that it doesn't add to the already delinquent portfolio. We were looking at the spends carefully, and we were always targeting a kind of market share increase, which got evidenced in market share in spends increasing by 1.6%. It reached 19.5% as of February 2021, up to which industry data is available. Card's share steadily increased by around 70 basis points, reached around 19%. Initially, of course, during Q1, we had challenges. I'm talking about April to June 2020, when we had even the point of sale locations were closed, and our open market channel, which generally contributes more than 50% to the new acquisition, that could not do well. But we have a partnership with the parent bank and the banker channel, particularly a program, share program, which actually came to the rescue of the company. So we were able to calibrate between these two channels, and overall we were able to maintain a good run rate in terms of a daily new acquisition. Obviously, when it came to preparing ourselves for the future risks, we were more conservative. Instead of postponing the problem, we thought it's better to recognize the risk and be conservative so that we are positioning ourselves for future in a better way. And that was evidenced in terms of increased provision coverage ratio, PCR, which increased by almost 12 percentage points. But despite that, because of a robust business model, we were able to end with a profit after tax of 175 crores, which is a 110% growth year on year.
Okay, so we are seeing a rise in NPAs, and now with the second wave, with localized lockdowns, there's a chance of higher delinquencies as well. What are you anticipating on ground? And even though you have made prudent provisions, do you expect to, have a need for further provisions in FY22?
Yeah, I think it contained a lot of questions, but nevertheless, this situation, what is prevailing now due to the second wave, I think is way different from what we have witnessed last year, where it was a kind of national lockdown, and it was uniformly implemented throughout the country, where access was cut off, movement was restricted, etc. This is more like a selective nature. Some of the big states have imposed much stricter restrictions on the movement, but it is open as usual in other states. So that way it is a bit different. Coming to the impact of this second wave, it's a bit too early to comment. Till third week, we were able to see our new acquisition or otherwise our spends, etc. They corresponded to what we used to do in March as well. But of course, states like Maharashtra, Delhi, Rajasthan kind of thing have imposed some restrictions. So some softening you can anticipate automatically in the point of sale location purchases, whatever the spends we see from that category. But there is also a kind of secular trend what we are seeing in the spends. If you have seen our analyst presentation where we said, already gave this data point, more than 51.9% of the spends are happening through online, which is almost 7 percentage points more than a year before. So we expect some kind of shift from pause to online within the constraints of movements, etc. Particularly the e-commerce, I think right now in some states is restricted to delivery of some essential items. But we hope this second wave will come under control. Government has ambitious vaccination programs from 1st of May. So we hope this will become normal soon. But coming to the preparedness wise, we are much better off as compared to last year. In fact, as on date, most of my staff are operating from home. So we have created that IT infrastructure where they can remotely connect to our systems and seamlessly work, whether it is a customer service, whether it is operations, or whether it is any other risk management kind of function, we are able to do remotely seamlessly. And of course, asset quality wise, we could envisage whatever risk that can be there. If you see like a RBI RE last quarter, December quarter, We even, the portfolio containing 30 plus delinquencies, we treated it on par with NPA and made a ECL related stage 3 provisioning for the portfolio. We went further this quarter because significant portion of the 777 crores, what was there last quarter, some part of it moved to NPA. So as a matter of abundant caution, we increased the provision coverage on that portfolio to 80%. So we are better off. I mean, we have been conservative, but it all depends upon the external situation, how long the impact will continue, whether it will come under control quickly. We are watching the developments very carefully.
Do you see the second wave could have an impact on your growth? And this, the reason why I'm asking you this question is because according to analyst projections, they are penciling in a 25% growth for this year. Do you see the sentiment on the street could have an impact on this growth?
I think whenever there is a kind of distress or otherwise, particularly during the peak of the pandemic, we could see postponement of discretionary spends. But at the same time, it has come back, a kind of pent-up demand has come back whenever things have opened up. If you look at our spends during Q3, our spends have reached the pre-COVID level by October itself. I think almost like 1 month ahead of the industry, we were able to reach the pre-COVID level. So perhaps I will only see like it's a postponement of the expenditure. Of course, I'm not talking about the travel kind of segment, which got impacted hugely. But other kind of spends, I think it will be mere postponement or fulfilling it through other channels if it is feasible. So it is only a deferment of that rather than complete loss. That is what I feel.
The second largest card player next to HDFC. While HDFC card book is about 63,000 crore, SBI card book is at 23,000 crore. Why is there such a huge gap and how are you planning to fill it?
I think if you're asking about NEA kind of market share, I think it's not in the public domain. So we also don't know what is the NEA of the competition. But net earning assets is a combination of several factors. The kind of portfolio what we are getting in, the kind of new acquisition what we are getting in, and the kind of spend rate and the kind of spends market share what we are capturing. Of course, you have to realize like a significant portion, almost 9% of our earlier revolvers got converted into a kind of EMI-based loans under RBI RE, and these cards were blocked actually in terms of further spends. So we will be able to unlock them based on their satisfactory payment record with us and their satisfactory bureau score. We will be able to unlock them, which will automatically increase the spends and then again revolver and automatically will contribute to increase in NEA. So it's a, I mean, as I said, it's a, we are always targeting a sustainable growth. We are calibrating our strategy to what's happening on the ground. We are trying to balance different factors. So we are watching it carefully.
Okay, on the digital front, what's the kind of growth in transactions that you're seeing there? Are we also likely to see, tech giants now coming into the payment space? And how are you planning to brace towards further competition? What are you seeing as your toughest competitor?
Our strategy has been two ways. I mean, wherever partnerships are possible, we are partnering. For example, we partnered with Paytm, we partnered with GeoPay, we partnered with Google Pay to, take our card as a kind of payment enabler to one of the, accept our credit card as one of the payment enablers. Second category wise, yes, there is competition. There is, particularly when we see the UPI kind of thing, we could see a lot of transactions, etc. happening, both in terms of value terms and number. But we look at it more in an optimistic way, where they are increasing the top of the funnel. In the sense, like we could see like a e-commerce play has expanded into tier 3, tier 4 towns also, where people who were actually dealing in cash got converted into digital. So this actually provides a kind of input for us in terms of looking at this segment, how much of it can be cardable. So it is a win-win. Actually, as the digital payment space is increasing, we are actually feeling like the cake size is also increasing. So we are not perturbed with competition, rather we are looking at it as an opportunity.
Okay. We did see Carlyle exiting partially recently. What would be the shareholding now, and would we see new investors coming into SBI Cards?
I cannot comment on their decision to offload, etc. But it is their call. I mean, they would have their internal kind of policies to unlock the value as and when they see value accretion happening. But as on date, they hold around 11.6%, if I'm correct. So by virtue of that, they still have a position in the board. So they continue to be part of the board.
All right, Mr. Amara, we'll leave it there. Thanks so much for joining us on the earnings this time around.